New investors lose an average of $4,000 per year by making the same 5 avoidable mistakes, and most don't even realize they're doing it. Hello, this is the CashMind Daily Team. We're breaking down the research on why beginners struggle with investing, not personal war stories, but actual data from the Federal Reserve, Bureau of Labor Statistics, and behavioral finance studies. Our goal today is to show you what the research reveals about the biggest investing errors, so you can avoid the costly detours that derail most new investors. Let's start with the foundation. Research from the Federal Reserve Survey of Household Economics shows the median American household has less than $5,000 in liquid savings. That's the starting point for most new investors: limited capital, high stakes, and maximum pressure to get it right. Yet data suggests that 70% of beginner investors make at least 3 of the 5 mistakes we're covering today. Over a 30-year investing timeline, these errors compound into 6-figure losses. Let's break down each one. Mistake #1. Investing without an emergency fund. This is where most beginners stumble, and the research is clear on why it matters. The Federal Reserve survey data shows the median household emergency fund sits around $5,000. That sounds low, and it is. But here's the critical insight. Studies analyzing investor behavior show that people who lack adequate emergency savings are 60% more likely to raid their investment accounts during unexpected expenses. Let's walk through the math. Imagine a household with $20,000 to invest in no emergency fund. A car repair costs $1,200. The water heater fails, another $2,500. Medical copay from an urgent care visit adds $300. 3 months in, that investor has withdrawn $4,000 from their portfolio to cover life's surprises. But here's what the research shows. They didn't just withdraw $4,000 of gains. They withdrew $4,000 of principal, money that over 30 years at a 7% average annual return would have grown to $38,000. This isn't theoretical. Vanguard's analysis of account behavior shows investors with inadequate emergency funds not only withdraw from investments at inopportune times, often during market downturns, they also panic sell at the worst possible moments. The data indicates this behavioral pattern results in missing 10 of the best 20 market days over a 30-year period, which cuts your return by more than half. Here's what the research recommends. Before investing a single dollar beyond your employer's 401k match, build a separate emergency fund covering 3-6 months of essential expenses. For the median American household spending about $4,500 per month on basic needs, that's $13,500 to $27,000 in a high-yield savings account earning 4.5% a pie separate from your investment accounts. This isn't lost money, it's insurance against making emotional investing decisions. Data shows households with adequate emergency funds stay invested through market downturns, while those without them panic sell and lock in losses. The difference in long-term returns is staggering: 8% annually vs 2% annually for panic sellers. Mistake #2. Underestimating the power of fees. This is a silent wealth killer, and most beginners don't see it coming. Let's use concrete numbers based on actual fund data. Imagine you invest $50,000 at age 25, planning to retire at 55. You add $500 per month consistently. At a 7% annual return with no fees, you'd accumulate approximately $745,000. Now let's model the same scenario with a 2.78% annual expense ratio, something you'd find in many actively managed mutual funds or robo-advisor platforms with premium tiers. That same $50,000 initial investment, same $500 monthly contribution, same 7% market return, but with fees, grows to only $465,000. That's a difference of $280,000 in lost wealth. But here's what research from Morningstar and Vanguard consistently shows. The average investor doesn't notice a 2% fee because it's charged quarterly on their statement as a small percentage. The psychological impact is invisible. Most beginners pay this cost without realizing they could access nearly identical investment vehicles for 0.05% to 0.20% annually through low-cost index funds or ETFs. Research on investor behavior published by the CFA Institute indicates that fee awareness jumps dramatically when investors understand it in terms of future dollars, not annual percentages. That $280,000 loss isn't some abstract number, it's the difference between retiring at 55 or working until 62. It's $280,000 in lost compound growth. Data from the Bureau of Labor Statistics on consumer investment costs shows that beginner investors spend an average of 1.5% more annually in fees compared to their experienced counterparts, primarily because they don't prioritize low-cost options. Studies tracking portfolio performance across fee tiers show that after fees, 85% of actively managed funds underperform their benchmark index over 15-year periods. The research recommendation is straightforward. Prioritize index funds and ETFs with expense ratios below 0.20%. A diversified portfolio of low-cost index funds tracking the S&P 500 total bond market and international equities can be built for less than 0.15% in average fees over 30 years. That difference in fees is worth $150,000 to $300,000 in your pocket instead of fund managers' pockets. Mistake #3. Emotional investing and market timing ***. This is where behavior meets returns and the data is humbling. Research from Morningstar analyzing investor returns versus fund returns shows that the average investor underperforms their own mutual funds by 1.5% to 3% annually. Why? Emotional trading, panic selling, hope-based holding. Here's a concrete example from historical data. During the 2020 COVID market crash, investors who sold their positions on March 23, the market bottom, locked in a 34% loss. Those who stayed invested recovered that loss within 14 months and went on to earn 57% returns by the end of 2021. Yet Vanguard data shows 40% of retail investors sold equity holdings during the March-April 2020 window, crystallizing losses they didn't need to realize. Data on market timing shows that if you missed just the 10 best days in the stock market over a 20-year period, your returns drop from 9.6% annually to 6.1% annually. Miss the 20 best days and your returns collapse to 4.6% annually. Behavioral research indicates that emotional traders miss these best days 60% of the time because they're sitting in cash waiting for confirmation that it's safe to invest. The research is clear. Buy and hold investors outperform active traders by an average of 4.6% annually. That's not a small difference. On a $100,000 portfolio over 30 years, that 4.6% difference compounds to approximately $500,000 in additional wealth. Psychological research on investor behavior shows this emotional pattern strengthens during market volatility. A study published in the Journal of Finance found that investors check their portfolio valuations 17 times more frequently during bear markets than during bull markets. Each check increases the likelihood of an emotional decision by 22%. The research solution: automate your investments. Set up automatic monthly contributions to your investment accounts regardless of market conditions. Establish a rebalancing schedule, typically annually or semi-annually, that's mechanical, not emotional. Most research recommends the don't look strategy. Set your allocation, automate contributions, and check in only once or twice per year. Data from Charles Schwab shows investors who rebalance mechanically on a schedule outperform those who rebalance emotionally by 1.8% annually. Mistake #4. Concentrating your portfolio ***. This mistake looks like confidence, but feels like financial ruin. Research on portfolio concentration shows that investing heavily in individual stocks or sectors increases portfolio volatility by 200% to 300% compared to diversified portfolios. Let's use data. A beginner invests $50,000 entirely in technology stocks, concentrated risk. The S&P 500 technology sector had a 33% drawdown in 2022. That concentrated $50,000 portfolio fell to $33,500. A diversified portfolio with 40% stocks and 60% bonds using low-cost index funds experienced only a 13% drawdown, falling to $43,500. That's a $10,000 difference in the same market environment, purely from concentration. Research from Vanguard analyzing 10 million portfolios shows that beginners are 3 times more likely to concentrate their investments in a single sector or theme stock than experienced investors. This concentration typically stems from overconfidence. I know tech will win, or narrative fallacy. Everyone says AI is the future. Behavioral finance research indicates this is called the narrative fallacy. Humans are pattern-seeking creatures, and a compelling story about a company or sector feels like due diligence. But the data shows concentrated bets fail more often than they succeed. For every concentrated portfolio that beats diversified returns, there are 4 that underperform. The academic research on diversification is overwhelming. A 2019 study analyzing 35 years of historical data shows that the correlation between diversification level and consistent returns is 0.87, nearly perfect. More diversification predicts more consistent returns. Less diversification predicts larger drawdowns and emotional pressure to sell at inopportune times. The research recommendation aligns with the 60/30/10 or 70/20/10 rule. Allocate 60-70% to a diversified mix of stock index funds, 20-30% to bond index funds, and 10% to alternative assets or individual stocks if desired. This structure provides growth potential while limiting catastrophic drawdown scenarios. Mistake #5. Ignoring the power of compound interest ***. This isn't a mistake in execution but in perspective. Research from Fidelity tracking retirement outcomes shows the strongest predictor of retirement security isn't investment performance. It's how early someone starts investing. Here's the math. A 25-year-old invests $3,000 per year in a low-cost index fund with 7% average annual returns until age 35, then stops contributing entirely. By age 65, that person has accumulated $1.05 million. A 35-year-old starts the same $3,000 annual contributions and invests consistently until age 65, 30 years of contributions instead of 10 years. That person accumulates $0.94 million, 10 years of starting early created $110,000 more wealth than 30 years of later contributions. This is compound growth in its purest form. Einstein allegedly called it the eighth wonder of the world, and the data supports it. Each year of market returns generates returns on the previous year's returns. A 7% return on $10,000 is $700. Next year, it's 7% on $10,700, which is $749. The $49 difference seems tiny, and it is, but over 40 years, that $49 difference compounds into tens of thousands. Fed data on retirement preparedness shows Americans are severely undersaved, with median retirement account balances around $87,000 at age 65. Research indicates this shortfall is primarily a starting late problem, not earning too little problem. Studies tracking households that began investing in their 20s versus 40s show the 20-year advantage creates 3-5x higher retirement balances despite identical contribution rates. The research message is unambiguous. Start now regardless of amount. Investing $100 per month from age 25 to 65 creates more wealth than investing $500 per month from age 45 to 65. Time compounds. Delay costs, bringing IT together, research on investor success shows that beginners who avoid these 5 mistakes accumulate 8 times more wealth over 30 years than those who make all 5. That's not a small difference, that's transformational. The data doesn't require genius-level investing. It requires discipline, perspective, and systems that prevent emotional decisions. An emergency